Imagine this for a second. It's a rainy Tuesday in November. You're stuck in traffic, your coffee's gone cold, the windshield wipers are doing that, that annoying squeaking thing.
The worst.
Right. And your mind just drifts off. You picture yourself on a wide teak terrace. The Andaman Sea is that perfect turquoise, the palm trees are swaying, and you've got a cold drink in your hand.
That's the dream. Your own villa in Phuket.
It's your villa. And for a moment, it feels like you've absolutely won at life.
It is the ultimate escapist fantasy, that paradise found moment.
Exactly. It's the dream. But here is where we need to pump the brakes. Today, we're going to take that emotional high, that dream of owning a slice of Thailand, and we're going to pour a bucket of cold, hard math all over it.
A necessary evil. Because if you don't, that dream can turn into a financial nightmare faster than a tropical squall blows in.
That's a vivid image. So we're stripping away the romance to look at the spreadsheets.
We're moving from pretty views to financial sense.
And to guide us, we are diving into a really comprehensive guide from Ocean Worldwide. Now, these aren't just some bloggers. They're a luxury real estate agency based right there in Phuket.
And they've been established since 2004.
That date is important, isn't it?
It's hugely significant. 2004. That means they've seen it all. The tsunami, global financial crises, political shifts, a pandemic.
Wow.
When you're looking at a market like that kind of longevity, that tells you they know what they're doing.
And we're specifically unpacking insights from their director, Sandra O'Neill. She's apparently helped thousands of families and investors navigate this whole process.
Right.
So our mission today is pretty simple. Master the calculation of ROI, return on investment, for the Phuket market.
And that's the jump, isn't it? From, I love this infinity pool, to, does this infinity pool make financial sense? That's where people stumble.
Okay, so let's start with the basics. The vocabulary. I feel like in real estate, people throw around rental yield and ROI like they're the same thing.
They're absolutely not the same thing. And Ocean Worldwide makes it clear that confusing them is a massive rookie mistake.
A dangerous one.
A very dangerous one. Think of rental yield as a snapshot. It's a quick, superficial look at your cash flow. The formula is super simple: annual rental income divided by the property value times 100.
Okay, so let's make that real. I buy a condo for, say, 10 million baht, and it brings in 800,000 baht a year in rent. So that's an 8% yield.
On paper, yes. And a lot of agents love to quote yield because it's a big, attractive number. Buy this and get 8%. But, and this is a huge, but yield is a vanity metric. It completely ignores capital appreciation.
Right.
And, crucially, it ignores all the costs. It assumes that 800,000 baht just lands in your pocket.
Which it obviously doesn't.
Not even close. And that's where ROI, return on investment, comes in. This is the sanity metric.
Okay.
The formula here is net profit divided by the total cost of investment. It answers the real question. After everything is paid, what am I actually making?
So yield is like looking at the speedometer, but ROI is checking the fuel gauge and the map to see if you'll actually get to your destination.
That is the perfect analogy. ROI forces you to confront all the friction, the costs, the taxes, the empty months. It's what separates a good investment from a very expensive mistake.
Let's talk about that friction, the hidden math. The source material flags this scenario they call the false positive, and I think this is where a lot of people get tripped up.
It happens all the time. An investor buys a place for, let's say, 10 million baht. A few years later, they sell for 11 million.
And they think, great, I made 1 million baht.
Brilliant. Champagne for everyone. But the math isn't that simple. In fact, the math is probably laughing at you in that moment.
Because once you deduct everything.
Once you deduct the purchase costs, the running costs over those years, you might find you've actually lost money. You've tied up your capital for years for nothing.
So let's break those costs down. What exactly are we talking about here? It's not just fixing a leaky tap, right?
No, not in a tropical environment. First, you have your acquisition costs.
Okay.
Legal fees, agent commissions. You're already down a few percentage points before you even get the keys.
Okay.
Then you have the operational costs. Common area management fees, they call them CAM fees.
So that's for things like the guards, the big swimming pool, the gym.
Exactly. And a luxury development, those can be pretty steep. Then you have what's called a sinking fund.
A sinking fund?
Yeah, it's a reserve fund for major future repairs, like repaving the complex roads or, fixing the entire roof.
And I've got to assume the climate itself is a huge expense factor.
It's the tropical tax.
Yeah.
We're talking salt air, intense UV from the sun, and monsoon-level humidity.
A brutal combination.
It just eats buildings.
Yeah.
Wood warps, metal rusts, air conditioners die young. You're not just doing minor repairs. You are literally battling the elements. If you don't budget for that, Your ROI calculation is just fiction.
There's one other factor Sandra O'Neill's data really highlights that I think people forget: the vacancy factor.
This is probably the biggest reality check of all. So many beginners calculate their potential income based on 52 weeks of rent.
Assuming the place is full every single night of the year.
Which is.
Yeah.
That's a fantasy. It's impossible. Even the best hotels in the world don't run at 100% occupancy.
Right.
You have to account for the low season, for the gaps between bookings, for the week you need to block off to repaint. You have to build your ROI on a realistic occupancy rate, maybe 60 or 70%, not a dream of 100.
So if we do all that, strip away the fantasy, do the real math, account for the salt air eating the air conditioner, is there actually any money to be made? What do the hard numbers from Ocean Worldwide say?
Surprisingly, yes. The numbers are actually quite robust, but only if you do it right. For rental yields, those snapshots we talked about, you're generally looking at between 6% and 8% annually.
Which, compared to a savings account right now, is pretty healthy cash flow.
It is, but the real story is the total ROI potential. For premium spots, like a beachfront villa or a high-end condo with a sea view, returns can hit up to 12% over a 5-year period.
Hold on, 12% total or annualized?
That's the annualized return, yeah, when you factor in capital appreciation.
Okay.
The data shows property values in Phuket have been climbing by about 5% to 15% each year.
15% capital growth in a single year, that sounds huge. Is that sustainable? What's driving it?
It does sound aggressive, but it's backed by real, tangible infrastructure development. This isn't just speculation. The airport expansion literally doubled capacity. There are new roads, tunnels, international schools.
So it's not just a tourist spot anymore.
Exactly. Phuket is shifting from being just a seasonal beach getaway to a year-round destination. And that shift is massive for that vacancy factor we just talked about.
It changes the entire game.
Completely. You're not just relying on holidaymakers in December. You have expats, families, people living and working there. And the numbers show the average time to see the investment payoff is around 12.5 years.
12.5 years?
Yeah.
How does that compare globally?
For a resort destination, it's very, very competitive. You compare that to buying an apartment in London or New York where your yields are maybe 2–3% and payoff times are, well, decades.
But Phuket is a big island. I assume you can't just throw a dart at a map and expect 15% growth.
No, absolutely not. Location is the variable that can swing your ROI wildly. The source breaks it down into a few different tiers. First, you have the established hubs: Patong, Koda, Karon.
The places everyone knows. Neon lights, busy beaches.
Right. High demand, but hyper-competitive. You'll get short-term rental income because tourists are always there, but the wear and tear is incredibly high. Your maintenance costs will be through the roof.
Okay, so that's the high-volume, high-maintenance option. What's next?
Then you've got the developing areas. This is where the smart money often looks for that capital growth. We're talking about places like Chermtale and Bangtao.
Bangtao keeps coming up in these discussions. What's the deal there?
It's where all the new infrastructure is landing. You've got the Laguna complex, new shopping centers. It's becoming this mix of holiday spot and long-term residential area.
So the entry price is lower, but the potential for growth is higher.
That's the idea.
Yeah.
The buy low, sell high candidate. Then, of course, you have the upscale spots. Kamala, Serene, sometimes called Millionaire's Mile.
Fewer cheap beers, more champagne.
Exactly. A very discerning clientele. You're getting wealthy families, not bachelor parties. The upside is way less wear and tear on the property. The downside is you have to offer a much higher standard to justify the price.
And the source also mentioned Phuket Town, which seems counterintuitive. I thought tourists just drive through it to get to the beach.
And that's why it's an overlooked gem for investors. It has this authentic, old-world feel. It's fantastic for long-term expat rentals, people who actually work on the island and don't want to live in a resort bubble.
So you pick your location, then you have to pick the property: condo, villa, townhouse. Is there a best option for ROI?
It really depends on your risk tolerance and how hands-on you want to be. Condos are sort of the set-it-and-forget-it option. The building management handles the exterior, the security, the pool. It's lower risk, an easier point of entry, great for digital nomads.
But the dream is always the villa, right?
It is. And villas command the highest nightly rates, no question. If you have a private pool, you can charge a huge premium. But, and this is a big but, they have the highest running costs.
You're on the hook for everything. The pool pump, the roof, the garden.
The whole 9 yards. So it's high risk, high reward. But the key thing Sandra O'Neill emphasizes is targeting. Don't try to rent a luxury villa to a budget backpacker.
Match the property to the person?
Precisely. If you buy a condo for a digital nomad, Make sure it has lightning-fast internet and a proper desk. If you buy a villa for families, focus on the pool and the outdoor BBQ area.
That makes perfect sense. And it leads us right into the operational side. You've bought the place. How do you actually squeeze the most profit out of it? The source talks a lot about seasonality strategy.
This is critical. You can't just have one price all year round. That's just leaving money on the table.
So you break down the calendar.
You have to. High season, that's November to April. You maximize your rates, no discounts. Demand is through the roof. That's when you make the bulk of your profit.
Then what?
Then you get the shoulder season. May, June, September, October. It's a bit trickier. You need to be competitive. This is where you use value adds.
So instead of slashing the price.
Exactly. You offer a free airport transfer or a stay 4 nights, get the 5th free deal. You sweeten the pot without devaluing your property.
And then the low season, July and August.
Here, cash flow's king. You offer discounts, you look for long stay incentives. Your goal is just to keep some money coming in because an empty house still costs you money.
Keep the engine idling.
Perfect way to put it. And another tactic they mentioned was renovation, but not like a massive overhaul.
Right, a spruce up.
Yeah, and this can have a huge impact on ROI. Fresh paint, modern lighting, maybe getting rid of a dated sofa. These small costs can let you raise your rental rate significantly because it's all about perceived value.
Okay, we have to talk about the elephant in the room for any overseas investment. Property management.
I cannot stress this enough. Unless you live in Phuket, you need a property manager. You absolutely need eyes and ears on the ground.
Ocean Worldwide quotes fees around 10 to 20% of rental income. That feels like a big slice of the pie.
What is a sting? I get it. But think about the alternative. You're in Chicago, it's 2 a.m., a pipe boosts in your Phuket villa. Who are you going to call?
I'm certainly not getting on a plane.
Exactly. A good manager handles bookings, check-ins, and crucially, has a local network of plumbers and electricians who they can call who won't rip you off.
So that 20% fee is basically buying you the ability to sleep at night.
And it's ensuring your asset doesn't fall apart from neglect. A poorly maintained tropical property loses value so fast.
Speaking of things that keep us up at night, let's get into the really boring stuff that keeps lawyers busy. Risk and legalities. This is where Thailand gets complicated, right?
It is unique. The first major hurdle is foreign ownership rules. Thailand is very protective of its land.
So, to be crystal clear, can I, as a foreigner, buy a piece of land with a house on it in my own name?
Generally speaking, no. Foreigners cannot directly own land.
So how is everyone doing it? You see foreigners in villas everywhere.
There are legal structures. The most common for a house or villa is a long-term leasehold. You lease the land for 30 years, usually with options to renew. You own the building on top of it, but you're leasing the dirt it sits on.
Okay. What about setting up a company? I've heard about that.
That's the other route. You set up a Thai company to own the land freehold. But it's complex. You have to have Thai shareholders, and the government is cracking down hard on fake nominee structures.
That sounds like a legal minefield.
It can be, which is why the advice from the source is non-negotiable. Get your own independent lawyer.
Yeah.
Do not use the seller's lawyer.
Got it. But condos are different.
Yes. Condos are the exception. The Condominium Act allows foreigners to own a condo unit outright freehold in their own name.
As long
as the total foreign ownership in that specific building stays under 49%.
So if there are 100 units, foreigners can own 49 of them.
That's it. Which is why condos are often the simplest and safest entry point for first-time investors. It's just much cleaner, legally.
Okay, what about the money itself? The source flagged currency fluctuations as a hidden risk.
It's a huge one. Your rental income, all your profit is in Thai baht. But your mortgage, your savings, your goals back home are probably in dollars or pounds or euros.
So if the baht suddenly weakens...
Where profit weakens with it, in real terms. The property could be performing perfectly, but you could still lose 10% of your return just on the exchange rate when you send the money home.
So you almost have to be a bit of a currency trader.
A little bit, or at least be aware of it. Maybe you keep some money in a Thai baht account for local expenses. You have to think about it strategically.
It just really drives home the point that this isn't a hobby. It's a business.
That is the absolute core message from Sandra and the team at Ocean Worldwide. It's a blend of lifestyle and finance, but the finance part only works if you respect the mechanics of it.
So to wrap this all up for you, the listener, what's the big takeaway?
I think it's that investing in Phuket is a very viable and potentially very lucrative option. I mean, returns of 6 to 8% yield and up to 12% total ROI. Those are hard to find in Western markets.
But it's not passive.
It's anything but passive. You have to master the math, you have to budget for the tropical tax on maintenance, and you absolutely must get the legal structure right from day one.
And leverage local experts. I mean, a company like Ocean Worldwide has been there since 2004 for a reason. They've seen it all.
Right. You need someone who will give you that reality check we talked about at the start. Someone who will tell you, no, don't buy that one. The foundation is a mess, not just someone who wants a commission.
Before we go, I want to leave you with one last thought. We've spent this whole time talking about ROI, return on investment, the money.
But there's another currency at play, isn't there?
There is. Let's call it the currency of stress.
Oh, I love that.
Even if your spreadsheet says you're making a 12% return, ask yourself this. If you didn't hire a good property manager, is the time you spend worrying about a leaking roof in a different time zone, is that worth the profit?
That's such a great question. If you're waking up at 3 a.m. to deal with an angry tenant because the internet is down, that 12% suddenly feels a lot less valuable. The best ROI might actually be peace of mind.
You want the check, not the headache.
Precisely. Structure the investment so you get the financial returns without the anxiety. That's the real win.
If you're ready to do the math and maybe find that peace of mind, you should definitely check out Ocean Worldwide for some expert guidance. You can visit them at oceanwwp.com.
They can help you run the real numbers on a specific property.
Thanks for diving deep with us today.
My pleasure.
We'll catch you on the next one.